The Hang Seng just delivered the kind of rebound that makes a weak market look healed overnight. Green candles, fast momentum, and a move large enough to pull attention back to China. But one line on the chart refuses to confirm the comeback.
Price moved first. That matters. When an index rebounds with this much speed, waiting for every indicator to turn can mean ignoring a real change in momentum.
Speed is not the same as escape. A rally can be powerful and still run directly into the structure that ended the previous advance.
That is the anomaly. How can an index jump roughly 3% and still remain technically trapped? The answer is sitting above price, not behind it. Start with what the headline return hides. Across the latest 3-session window, the Hang Seng rose from roughly 23,500 to about 24,200. That is a gain of approximately 3%.
On a short chart, that is not noise. Buyers took control of the recent bars, the index moved away from its low, and the rebound became visible enough to challenge the bearish mood.
But the endpoint is still below the Ichimoku cloud. The index changed direction without yet changing regime.
The cloud is not a prediction. It is a map of prior balance projected forward. When price remains below it, the zone above can contain traders who waited through the decline and now see the rebound as an exit.
Momentum traders focus on sequence. A higher low followed by a stronger close can attract more participation before price reaches the cloud. If that sequence continues, the resistance zone begins to look less permanent.
But the cloud is wide enough to make the distinction important. Touching its lower edge would only begin the test. Entering the cloud would show that the old bearish structure is losing control. Clearing the roof and holding above it would be stronger evidence of a regime change.
So there are 3 different events: a rebound below the cloud, a test inside the cloud, and acceptance above the cloud. They are often compressed into one word, breakout, even though they describe very different market conditions.
The first event has already happened. The rebound is real.
The third has not. The escape is unproven.
Now add the baseline in the Ichimoku system. It represents a midpoint of the recent trading range and often acts as a balance level after a sharp move.
If price reaches the baseline and holds rather than immediately rejecting, the rally gains structural confirmation. Momentum would no longer be surviving only on the speed of the first bounce.
If price stalls beneath that line, the same 3% move can become a trap. Late buyers would be entering just as earlier holders meet a familiar resistance area.
That is why the size of a rebound cannot answer the most important question. The chart must show whether buyers can keep control after the easy part of the move is over. The Bollinger structure adds another clue. Bandwidth has been contracting around the recent range.
Compression after a rebound can be constructive. It means the index is storing energy instead of immediately surrendering the move. If price presses the upper band while the band begins to expand, momentum is finding follow-through.
Compression is direction neutral. The same stored energy can release downward if price fails at resistance. The band does not choose the winner, it shows that the quiet phase may not last.
This is where traders often combine 2 separate observations incorrectly. A strong rebound says buyers controlled the recent path. A squeeze says volatility has contracted. Neither statement proves that the cloud will break.
The momentum case needs a clean sequence. Price holds the rebound, reaches the baseline, enters the cloud, and avoids falling straight back below the range.
The invalidation is equally clear. If the index rejects beneath the cloud and loses the low that launched the rebound, the 3% gain was relief inside a bearish structure, not the beginning of a new regime.
Notice that neither case requires a forecast. We are defining what the chart would have to do before changing the label attached to the move. The macro caveat is that the Hang Seng does not trade in isolation. Currency conditions, Chinese growth expectations, property stress, and global risk appetite can all affect whether international capital follows the first bounce.
If broader risk assets strengthen at the same time, the chart has a tailwind. More markets would be confirming that the rebound reflects improving appetite rather than a local short covering burst.
If the rebound remains isolated while yields or the dollar tighten global conditions, the cloud becomes more difficult to clear. A technical breakout still needs participation after the initial excitement fades.
So the strange answer is simple. The Hang Seng can rise 3% and still be trapped because return measures distance, while the cloud measures structure.
The distance already changed. Momentum deserves to be taken seriously.
The structure has not changed yet. Resistance deserves the same respect.
The next time an index surges from a low, do not ask only how far it moved. Ask where it moved from, what it moved into, and what level would turn a rebound into an actual regime change. That is the experiment. Subscribe for the next Weekend Lab, and follow the Daily Market Notes at Market Validation Lab on X.